In this video, I'm going to discuss two absolutely beaten down growth stocks that you should avoid in April. The two stocks, Skills and Fubo TV. I'm going to show you critical financial metrics to demonstrate why investors should avoid these two growth stocks in April. So let's get started. Looking at their price performance, looking at Skills and Fubo TV going back to 2020, their stocks are down 98.2 and 98.75% off their highs. Absolutely hammered. These stocks have lost nearly 100% of their value since since roughly January of 2021 when these stocks reached their all-time highs. It's been devastating, and this significant price crash has a lot of investors asking if they should buy the dip in these two growth stocks, and my answer is not yet. Not yet. So for April, I'm saying investors should avoid these two growth stocks. And here is why. So let's look at quarterly revenue growth for these two stocks. Look at Fubo TV in the orange, significantly decelerated revenue growth all the way down to just 38.47% in its most recent quarter. I wouldn't be surprised if that moves even lower going forward. And Skills has already went negative in terms of revenue, negative 59.32% in its most recent quarter after it was growing very nicely in the early parts of 2020 and 2021. The reason I say Fubo TV it should experience lower revenue growth is because the company has finally realized that it needs to raise prices and lower expenses in order to put the business on sustainable footing, and those actions are likely to turn off customers and potential customers going forward. And so that's going to be pressure on Fubo TV. But I think it's a good move by management because the company was losing, and I'll show you in a little bit just how much money the company was losing on the bottom line. It was just unsustainable. And now that the Federal Reserve has went on an ambitious interest rate increasing campaign, this has increased the cost of capital for Skills and Fubo TV and many other companies. And so, since the cost of capital is higher, losing money on the bottom line, the cost of those losses are higher because investors are looking more for companies that are generating profits and cash flow from operations as the cost of capital increases, because for the simple reason that the opportunity cost is higher, right? Investors can take their money and put it into government bonds and earn nearly 5% depending on the maturity that they choose. Short term, 6-month maturities or 12-month maturities. Some maturities are yielding over 5% in safe government bonds. Or you could go out, 10 years and get, 3.2, 3.3% 10-year yields on government bonds. So safe 3.3% yields. And so investors are asking themselves, why would we put our money in these unprofitable growth stocks when we have a reasonable option in long-term government bonds or short-term government bonds to increase our wealth? This story was different 2 and 3 years ago when government bonds were closer to less than 1%. At the heights of the pandemic, the 10-year government bond went as low as 0.5%. So at that time, investors had fewer options on where they could put their money. They were more willing to invest in unprofitable growth stocks like Skills and Fubo TV, but the tide has quickly changed with the rapid interest rate increases. Money has moved towards government bonds because they're attractive in the risk versus reward that they're offering. And so let me show you the losses on the bottom line. This is net income as a percentage of annual revenue. Fubo TV was really bad in this metric at over 240% in net losses on the bottom line, but the company has made several slow, methodical steps to reduce those losses on the bottom line. First, by reducing its investment in rolling out the online sportsbook. Remember, Fubo TV was really trying to become a major player in the online sportsbook industry. It's meaningfully lowered its ambitions there, and so lowered its spending on trying to ramp that up. That's improved its profit margin. And then it also has instituted price increases. And so that's improved its profit margin. It's also lowered its spending on content. That's slowly improved its profit margin. So all of these steps the company is taking to move towards a lower net profit loss has helped bring its losses down to a negative 55%, although it's still really big in terms of looking at the loss. It's losing 55% of every dollar in sales. So for every dollar in sales, the company is losing 55 cents on the bottom line. That's not a good ratio, and that's kind of flatlined recently, suggesting the company needs to raise prices more meaningfully and reduce costs more meaningfully in order to reduce those losses. Skills, meanwhile, similarly, very bad in terms of losses on the bottom line. 162.7% in its most recent update, although Skills also has made big moves to reduce those losses on the bottom line. And I suspect in the next quarter, Skills year-over-year net loss is likely to have a significant improvement. Because the company finally slashed its spending on sales and marketing. It was addicted to spending over 100% of revenue on sales and marketing for the longest time, and it finally slashed that expense in its most recent quarter. And so in the next quarter, when it updates investors, I suspect its net loss will be way, way lower than where it is right now. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So looking at their valuation, I mean, they've taken a big hit as I highlighted earlier in the video, but looking at the just the price to sales ratio of 0.8 and 0.2 is a bit deceptive, because you can look at it and say, oh, Skills at 0.8 is way lower than the over 45 it was trading at, and the same with Fubo at 0.2 is way lower than the near 20 it was selling at. But you have to keep in mind that the steps that these two companies are taking are going to reduce sales. Right? Fubo TV is raising prices and lowering content spending. That's going to turn off a lot of customers, and they're going to go away. So sales are going to fall, and you're looking at price to sales. So the denominator is going to fall, and the price at this current rate means that you're going to pay a more expensive price because future sales are expected to fall or decelerate in terms of growth. The same with Skills. It's slashed sales and marketing expense, and so sales are expected to fall as a result of that, right? Even though it's a good move, in my opinion, it's necessary. The result usually is when you slash investing on sales and marketing, it leads to decelerating or decreasing revenue, especially for a company like Skills, which, their sales and marketing spending directly results in customer acquisition, because they offer customers a deposit bonus or a reload bonus or an activity bonus or an engagement bonus. All of that increases customer engagement and customer deposits, resulting in revenue. So if they reduce those expenses, it's going to reduce those customers coming in and depositing and engaging because of those bonuses. So for that reason, looking at the price to sales might be a little bit misleading, might make you think you're getting a better value than you're actually getting. So for all of the reasons I mentioned, I think Skills and Fubo TV are two really beaten down growth stocks that investors should avoid in April. Now, if you're interested in beaten down growth stocks that you can buy right now, I've got videos popping up on your screen right now for several of those stocks that you can buy. So click on one of those and you're going to find what you're looking for. Thank you so much for watching. I'll see you over there.